Welcome to a short video showing the valuation of a non-growth stock or preferred stock. Now, if all the profits are paid to the stockholders and not retained, it's impossible for a company to grow. Therefore, growth is not considered into this calculation. Generally, this does not occur, and we usually reserve this formula for the valuation of preferred stocks. Now, the par value represents the claim of the preferred stockholder against the value of the firm. This is the stock price. Now, with bonds, it was the initial $1,000 issue price or the $1,000 maturity value, which is also referred to as par or face value. Now, preferred stocks are a hybrid in that they are similar to stocks since they represent ownership, but the payment is fixed like a bond. A company is not locked into paying that year like they would be with a bond, but eventually they must pay. Preferred dividends are fixed and provide cumulative dividends, which means that past preferred stock dividends not paid will be paid in the future before common stock dividends. Now, since the preferred are generally fixed, preferred stock can be valued as a constant growth stock with a dividend rate equal to 0. Thus, the price of the share of preferred stock can be determined using this following equation, which states that the par value of the preferred equals the dividend of the preferred divided by R, or the required rate of return on this particular asset. So find the price of a share of preferred stock given that the par value is $100 per share and the preferred dividend rate is 8% and the required rate of return is 10%. Using the equation, we find that the preferred stock price is $80. Now, what does this mean? If the required rate of return based on the capital asset pricing model is 10% and the par value is $80, an investor would require 10% divided by the $80, or a yearly dividend return of $8 or $2 per quarter. The $8 represents a 10% return on the initial $80 stock price.